All right, let's talk about market cap. You hear this term thrown around everywhere, right? On the news, in your group chats. It's like the ultimate scorecard for how big a company is. But what does that giant number, the one with all the zeros, really tell us? Let's dig in.
I mean, you've definitely seen headlines just like this. NVIDIA surpasses $4 trillion? It's insane. These mind-boggling numbers get tossed around like they're the final word on how much a company is worth.
So, you gotta ask, what is this number? Is market cap really the whole story? Or, and this is the important part, is there something critical that those flashy headlines are leaving out? Well, that's exactly what we're here to find out.
Okay, so first things first, let's get right down to it. What is market cap? At its heart, it's actually a pretty simple idea. It's the total market value of a company's shares, the ones that are out there, owned by investors. Basically, think of it like this. If you wanted to buy every single share of a company and own the whole thing, market cap is the sticker price.
And the math behind it? It's way simpler than you might think. Seriously. All you do is take the current stock price, what one share costs right now, and multiply it by the total number of shares out there. That's it. That simple little calculation is what gives you those crazy multi-trillion-dollar numbers you see in the headlines.
So, what's the point of this number? Well, its main job is pretty straightforward. It helps investors and analysts sort companies by size, kind of like putting them into different weight classes in boxing. And this is pretty much how it works. You've got these standard categories. At the very top, you have the heavyweights, the mega caps. We're talking companies worth over $200 billion. Then you work your way down through large cap, mid cap, and small cap. Each one has its own range. But here's the thing. These aren't just random labels. They're actually shorthand for what an investor can expect. Your large caps, like an Apple or a Microsoft, they're usually the big, stable giants. Less risk, but maybe slower growth. Then on the other end, you have the small caps. They've got way more potential to grow fast, but you guessed it, they also come with a lot more risk and volatility. Mid caps, they're kind of in that sweet spot in the middle, trying to give you a bit of both.
Okay, but this is where the plot thickens. If market cap is so great and simple, why isn't it the end of the story? Well, it's because it's missing a huge piece of the puzzle. And this right here is the absolute key. Market cap only looks at the equity, the value of the shares. It tells you absolutely nothing about a company's debt. And that's a massive, massive blind spot.
Let's use an analogy to make this super clear. Think about a house. Imagine two houses, both for sale for $1 million. They look identical. But here's the catch. One is completely paid off, zero mortgage. The other one has a $700,000 mortgage still on it. So, are they really worth the same? To a buyer, no way.
Right. In that second house, the owner's actual stake, their equity, is only $300,000. And that is exactly like a company's market cap. It's just the equity part. But the true cost to buy that house, to take it over completely, you'd have to pay the full $1 million because you're also taking on that mortgage. That's the real acquisition cost.
So, if market cap is just the tip of the iceberg, just the equity part, how do we see the whole picture for a company? How do we find that true cost? Well, for that, we need a better tool.
And that's where enterprise value, or EV, comes in. This is the metric that savvy investors use because it gives a much more complete picture. It's not just looking at the stock value, it's looking at the total value of the company. That means the equity plus all of its debt.
And how you calculate it actually makes a ton of sense when you think about it. You start with the market cap, then you add all the company's debt because if you bought the company, you'd have to pay that off, right? And then you subtract any cash the company has on its books because you could use that cash to pay down the debt or pay yourself back right away.
Okay, so now we have our two big players, market cap and enterprise value. Let's put them head to head to really see what's what. So to sum it up, market cap, it's all about the equity. It's great for a quick glance at a company's size, but its big blind spot, its fatal flaw, is that it completely ignores debt. Enterprise value, on the other hand, gives you the value of the entire business. It's the true theoretical takeover price. It gives you the full story.
All right, I know what you might be thinking. This is all a bit technical. Does this really matter in the real world? Oh, you better believe it does. And I've got a perfect, kind of crazy example to prove it.
Get this. Back in early 2020, Zoom, the video call company, had a market cap that was higher than 7 of the biggest airlines in the world combined. Just let that sink in. One software company was, on paper, worth more than a huge chunk of the global airline industry, with all their planes, their routes, their employees, everything.
How is that even possible? I mean, was Zoom's business really bigger than all those airlines put together? Of course not. Not even close.
The secret, the whole reason for that weird situation, was debt, and market cap was completely blind to it. See, airlines are what we call asset-heavy. They have to borrow billions and billions of dollars to buy their planes. So their market caps might not look huge, but once you calculate their enterprise value and add back all that debt, their true value is enormous. Zoom, on the other hand, is a software company. It had very little debt, so its market cap and its enterprise value were pretty much the same.
So let's boil this all down. What do you really need to remember? Number one, market cap is a simple, useful metric for a company's size, based just on its stock value. Number two, enterprise value gives you that much more complete picture of a company's total value. And maybe the most important thing, EV shows you the real-world acquisition cost because it forces you to account for all that debt. So I'll leave you with this thought. The next time you see one of those big, flashy headlines about a company's value hitting some new record, you'll know to stop and ask yourself the real question. Are they just talking about market cap, or are they talking about the value of the entire enterprise? It makes all the difference. Thanks for diving into this with me.